All right, we're going to talk a little bit about, first of all, some concepts relating to joint cost, and then we'll take a look at the application of how do you determine the joint cost that need to be applied to different products. Now, remember that a joint cost is something that arises because a product, let's say lumber, comes in with the trees. You apply, that would be the materials, you apply labor and overhead, and sort of simultaneously you end up with a number of different products. Well, that lumber, the material, the labor, the overhead are the joint cost. So the joint cost needs to be allocated between the different products that are produced, primarily to value inventory, which is a gap issue, but also so that not only for inventory, but then cost of goods sold. Secondarily would be the issue of profit, perhaps. Now, a separable cost is something that occurs only if a company decides that they're going to process the product further. So, for example, if you're taking raw milk and you may come up with, let's say, 2% milk. Well, that 2% milk could then be processed further to create, let's say, cottage cheese. So the cost of moving from 2% milk to cottage cheese would be a separable cost. Now, a byproduct is by definition something that has little or no sales value. In fact, sometimes you have to pay to have byproducts carted away. So generally what we're going to be looking at is either products which have a relatively decent sales value or those that have nothing. In reality, some things fall in between, but for our purposes, we'll basically kind of keep it to that. Now, allocating joint cost is one of the issues that come up here. One, for GAAP or financial accounting. That is, whatever I produce, those manufacturing costs need to be reflected in the cost of inventory and hence cost of goods sold. Another would be if I have a fire or something happens. Well, okay, what was the cost of the inventory that was destroyed? I need to establish that. If you're dealing with rate regulation, okay, fine, I need to establish cost. So there are a lot of reasons why some of which are a little bit more esoteric, but mostly what we're going to look at would be for financial reporting. Okay, joint production cost, those things are going to be either stay in inventory because the joint product has not been sold, or it becomes cost of goods sold. And it's sold. Now we'll kind of look at number 8 and then also 10, 11, the different types of the different ways that you can allocate joint cost. And we'll talk about the sales value to split off point, net realizable value, constant gross margin. You could even do physical measures, although that's not necessarily recommended. There are some inherent problems with it. Now, again, the choice of methods is arbitrary. Sales value is often considered a little bit better because it has more objective information. You know for certain what the sales value of the products are at the split off point. What's less certain is what you can get for them if you process them further. But we'll go through those, look at some examples of how those things are determined. Now, number 13 is an important one, and that is that once you determine the joint cost that are going to be allocated to each product, the choice of what I do with a product will never, never, never include joint cost. That is, once the product arises at the split-off point, joint costs are by their very nature historical. They are therefore sunk cost. Therefore, they would never be relevant in deciding what you're going to do with a product. The only thing that would be relevant would be what are those incremental or separable costs, such as moving that 2% milk, creating it, moving it into, making it into cottage cheese, and what would be the incremental revenues that I could get from that. In no way would I ever look at, oh, how much joint cost was allocated to that. So joint costs are interesting But they're only used to value, if you will, the inventory, or to cost the inventory and cost of goods sold. They are never used to decide, what do I do with the product? And that seems a little bit different. It seems to be a little bit strange. With respect to how you handle byproducts, we'll look at the production method, the sales value method, and we'll look at some examples of that. All right, in number 20, we're going to look at probably the two more, if you will, complicated methods for allocating joint cost. One being the net realizable value, and then the second being constant gross margin. But a couple of things. One, to be very clear about the quantities that you're dealing with. In this case, you have X, Y, and Z. That 68,000 were sold, okay, 400 were sold, 672 were sold. And then you also have these ending inventory amounts here. The joint cost are 580,000, okay? And the separable cost, because there's nothing you can't sell Z at the split off point. It can only be processed further. That's why you have to, in this sense, in a strict sense, you can't use the sales value to split off point method because Z is not available to be sold. You absolutely have to incur that. So the more appropriate method would be net realizable value or the constant gross margin method. All right, so given the basic information here, what they came up with here, first of all, in the solution is to make sure, again, how many units were produced, okay? The 200, 600, 700 for each, for X, Y, and Z. You get that by it's an application of B plus A equals E plus D formula, okay? The only way that I can sell and end up with ending inventories, 132, is that the production was 200, okay? In other words, if the production was 200, I sell 68, I will end up with 132 left, so on. So part of it may seem very simple, but oftentimes people are stymied and they get real frustrated because they don't do this step right here to make sure that they're real clear about the inventory part of it. Now, the net realizable value method is to look at, excuse me, what can I get for each product, okay? Now, in this case, what they tell you is that we're going to look at the sales value. In this case, X and Y, what you can get for it at the split-off point. In the case of X and Y, there really is no need to do any additional processing. They're available to be sold, and assume that's really all we're going to get. So given the total production, okay, not sales, but the total production, we're looking at what are the total revenues that we could potentially generate with the three products, given that level of production. And looking at their relative sales values, $1,200 for X per unit, $900 for Y, and $600 for Z. And now with Z, the one that you have to be careful of is that Z also has a separable cost. So that while I can generate the $420,000 of revenues from it, I can only do that if and only if I incur the additional $200,000 of separable cost. So the net realizable value for X and Y would be the amount that I would generate at the split-off point. For Z, it's the sales value minus the separable cost, or 220. So again, if I'm looking at the company as a whole, the net realizable value for the company as a whole is $1 million. And so you get these respective percentages, 24, 54, and 22%. So what I'm going to do is I'm going to allocate my joint cost, okay, of 580 based on the relative net realizable value for each product, okay? And that we come back to those percentages. So I'm going to take the 580,000 times 24% times 54% times 22%. I will therefore allocate 139,200 to X, 313,200 to Y, and 127,000 to Z, based solely on their net realizable value. But keep in mind that X and Y, I'm not going to do anything with it beyond the split-off point. Z is the only one I'm going to process beyond the split-off point. Okay, so those, now, what this is right here, it's kind of a recapitulation of the inventories. So the total production, we know that ending inventory, so again, the ending inventory percentages. And so now, there are two different elements here with panel A and essentially panel B, okay? The first thing I have to do here is, again, I want to prepare my income statement. What I did up here was to allocate joint cost. So now with X, they sell 68 units. Y, they sell 480. Z sells 672 units, okay? Now, the costs that have been allocated are twofold. One, I have my joint costs that were allocated to each product based on their net realizable value. And Z has its own separable cost. So the total cost here are $780,000. The $508,000 of joint cost plus the $200,000 of separable cost, but the separable cost can only be attributed to Z. Okay, so $139,200 of cost attributed to X, $313,200 to Y, $327,600 to Z. Now, at that point, okay, I could kind of draw a line here, say, okay, fine. I could divide this by the total production, come up with my cost per unit, and then allocate that between ending inventory and cost of goods sold, okay? So if I have 132 units in ending inventory, okay, that's where we come back to 66%. All right, well, I take 66% times that, that's my cost of goods sold, okay? And again, 20% of my inventory is in ending inventory, 4% for Z. So the ending inventory values are 62,640, 13,104 for Z, and come up with a cost of goods sold. Once I have that, okay, I can likewise calculate my gross margin. They're kind of bunching a bunch of things together in here to makes it look a little bit more confusing than what it really is. All right. Now remember, if you look at here, one of the things that comes up if I use net realizable value or I use a sales value to split off point is that and the choice is an arbitrary one. I'm pushing certain costs to different products. And if I'm not careful, I can make one product look a lot better than another, simply based on the gross margin. And oftentimes, gross margin is an important consideration in deciding to keep a product or not to keep it. Because again, gross margin is what's left to pay for other costs that a particular product may incur, such as support department costs and things like that. Now, one way that I can avoid that issue and maybe look for other ways to evaluate a company is to guarantee that each of these products will have the same gross margin. And the way I do that is first of all, I have to determine what is the gross margin for the company as a whole. Well, again, if the total revenues they could potentially produce based on total production is 1.2 million, and we already know that the total cost is 780, the gross margin is 420,000 or 35%. All right, well, the constant gross margin method is really a process of elimination. So I want to start, first of all, with my sales. What are the total revenues, or my total revenues, sales, whatever, that I could potentially generate from each product? And then the first step is to, if you will, skim off the guaranteed gross margin. Okay, that 35% times their respective sales values, okay? And so if I generate $240,000 of revenue, I'm going to guarantee that X will have a gross margin of 35%, or 84,000, 189,000 for Y, and 147,000 for Z. Okay, so what I'm left with here, the 156, the 351, 270, well, those are my costs. It's kind of turning the income statement upside down, working from the bottom up. Well, because both X and Y are not being processed beyond the split off point, that's it. I will allocate 156,000 of cost to X, 351,000 to Y, and each product will get us 35% gross margin. All right. Now with Z, it's a little bit, there's an additional step here. Okay, they get their gross margin, so I subtract the 147, but I also have to subtract out, if you will, the separable cost of 200,000. So Z will only have allocated 73,000. So the total joint cost here equal what I started with, 580,000. Each product will have its own cost, okay? And again, the total costs that are allocated are going to be slightly different depending on the amount that I allocate. The total cost here, 156, 351, and total cost of 273, of which 73,000 would be joint cost for product Z. Now, what I'm doing here is creating the income statement. Looking at, and I could take the 156, 351, 273, divided by the total production, come up with the cost per unit, however you want to do that. Okay. But here are my total costs that I'm allocating to each product. And I go back to those percentages. Okay, that is my ending inventory. So if my total cost of 156, my ending inventory is that amount, my cost of goods sold is that. And therefore, at that level of sales, and again, the level of sales will not affect gross margin. It doesn't matter. Okay, each product will generate 35% gross margin. These are two examples of using the net realizable value method. Net realizable value method is appropriate where you have to take a product beyond the split-off point. Constant gross margin is appropriate, if you want to avoid political squabbles within a company. Just say, hey, look, every product will get the same gross margin. We'll find some other ways to evaluate managers. Okay, so we're going to look at number 22, which looks at several methods of allocating joint costs, namely the sales value to split-off point, the physical measures, and net realizable value method. And so the joint costs here are 400,000. They give you some inventory figures here. Production of 20,000 of the beef, 28,000 of shrimp, also their respective selling prices of 5 and 20. And also, too, they give you some information that with these, there is a possibility of processing it further. That with additional cost, that the product can be enhanced and sold at a greater value. Okay, so the special B represents the beef ramen that can be processed further, but it can only be processed further to enhance the sales value if you incur the $100,000 of separable cost. The same thing is going to be true with the special S, that is the shrimp ramen, can generate more revenue per unit, but only if you incur the $238,000 of separable costs. So those things have to be taken into consideration when you look at the net realizable value method. Okay, so allocating joint costs under sales value to split-off point, I look at the amount of production, the 20,000 of beef, the 28,000 of shrimp, times the respective sales value of 5 for the beef, 20 for the shrimp. Okay, here are my sales values at the split-off point, a total of 660. So just take 100 over 660, 560 over 660. I end up with 15%, 1585 split. Fine. 15% of my joint cost of 400,000, 60,000 of cost would be allocated to the beef, and 340,000. Now, generally speaking, that's considered to be the most objective because you are virtually certain of the sales value of the split-off point. Beyond that, it's not quite as certain. Okay, and then you just bring down the information I have here to create the income statement, where I have the revenues that I would generate from each of the products, the joint cost, okay, the 60, the 340, okay, and the preparation of the income statement is a little confusing because what they've done is that they've allocated the joint cost based on the assumption that the items are going to be sold at the split-off point. But in reality, the company has made a decision that they're really going to process them both further so that the cost are a two-step. One, the allocation of joint cost plus the separable costs that are incurred with each particular product. Okay, so the total cost for B would be the 60 plus 100, or my 265, or excuse me, 160,000. The gross margin would be 265. So I have the total cost here of 340 of joint cost, 238 of separable cost, which gives me a gross margin of 554. So the total gross margin for the company is 809,000, okay, of which 265 is beef, the 544 is the shrimp. But on the income statement, again, what we're looking at is the fact that from the information, 25,000 tons were sold of beef, 34,000 of S, okay. These are the products that we incurred the separable cost to process them further. Now, physical measures is going to be based on the amount of production, okay, at the split up point. And in this case, from the information, 20 and 28,000 to the 48,000, or 42-58% split. So again, 168, 232 would be the amount of cost. Hard to justify that. I mean, it could be done. Doesn't necessarily mean that it should be done. Again, the calculation of gross margin, the amount of revenues are going to be the same, but I'm looking at the joint cost of 168 and 232 and the separable cost, because the assumption is I'm going to process these things further. Again, what I do with joint cost is up to me, and I have one of several methods. The separable costs are being incurred because, from an economic and financial point of view, the company is better off by processing and selling them enhanced. So you're always going to do what's in the best interest of the company. How I choose to allocate the joint cost is an arbitrary one. In many cases, the differences amongst the methods would be immaterial, so it's not really going to matter that much. Okay. So again, the total cost here, and then the allocation of the total cost here. So you're going to end up with a slightly different, actually almost kind of reversal of the gross margins. Now again, it's kind of hidden in the fine print here, but the assumption is that all of the enhanced product is being sold. That's why in both cases, in panel A and panel B here, 1A and 1B, all of the costs are allocated in calculating the joint cost, which makes it a little bit easier to do. I don't have to worry about allocating it between ending inventory and cost of goods sold. Okay, again, all of the enhanced product of B and S were sold. 25,000 of B, the 34,000 of S, in both cases here, so therefore I end up with this amount. Okay, allocating costs based on net realizable value. Well, again, we're going to look at the total sales value beyond the split off point. Okay, that doesn't change, assuming that you can sell all of B and all of S. All of B would constitute 25,000 tons at $17 per ton. All of S would be 34,000 tons at $33 per ton. So if I can take both B and S, sell all of them, you generate $1.547 million. The separable cost of those things that are incurred beyond the split off point. So the net realizable value of B, why I would do it, okay? I can look at what I could sell the product for at the split off point. As long as the net realizable value is greater, then I would do it. Okay, so if I go back to my original information, okay, what we're going to do is we're going to look at these numbers right here. If you sell the beef ramen, but only at the split up point, the most that you can make for it is $100,000, 20,000 tons at $5 per ton. Why would I do this? Well, if I pay an extra $100,000, I can certainly increase my sales value. I can go from generating $100,000 of profit to $325,000. That's certainly better. The $100,000 investment is certainly worthwhile. Likewise, okay, if at the split up point, the most that you can make for the shrimp ramen is $560,000. So if they incur the additional $230,000, $238,000 to process it further, they can generate more revenues. But it's not so much the revenues, but what do I net out? Well, you can go from $560,000 to $884,000. You know, over a $300,000 increase. So in both cases, the incremental cost more than pay for themselves as a type of investment. Okay, and that's one of the other essential elements in this chapter. How, when, and why would I enhance a product? Well, only if I can change the outcome. If I can go from $100,000 net realizable value, which is all I get at the split off point for the beef ramen, to get $325,000, I'll do it. To go from $560,000 for the shrimp, to get $884,000, I'll do it. Okay, that is why I enhance the product. Now, having said that, these are my net realizable values at the split off point, or excuse me, beyond that split off point if I process them further. So given the total net realizable value, we're going to split it 27 and 73. So of that joint cost, okay, of $240,000, we're going to allocate $108,000, or of the joint cost of $400,000, $108 would be allocated to B, and the $292,000 to S. And then beyond that, because we're selling all of that products beyond the split off point, then all of the costs, both the separable and the joint cost, are going to get allocated. And in this case, pretty comparable in terms of gross margins. All right, we're going to look at, finally, the last one here, number 24, looks at what do you do about a byproduct. In this case, the byproduct is identified. Okay, they produced 8,500 pounds, okay, sales are 6,500, and the selling price per pound is $10. Don't worry about it. They're telling you that this is a byproduct. Now, the simplest method, the easiest way to handle byproducts is to use what's called the sales method. In which case, if I'm selling 6,500 pounds of these at $10 per pound, I will generate additional revenue of the byproduct for $65,000. Simply add that to my total revenues. Cost of goods sold is still the same. Okay, allocate it and calculate it based on my good production. So the only thing that really changes here is the enhanced revenue feature here. Very popular with a lot of companies, but because of its simplicity. However, one of the problems with it is that, do I have good internal control over my cash transactions? So one of the ways that you can perhaps get a little bit better internal control over cash transactions, and again, there's always kind of a balance here in terms of cost and benefit, is that what I'm going to do is I'm going to take not add to revenues the amount of byproduct, but rather what I'm going to do is I'm going to take, here are my total manufacturing cost, and subtract out the amount that I would get if I sold all of the byproduct. So if I sold all the byproduct, I would get $85,000. So my total net manufacturing costs that I'm going to allocate between cost of goods sold and ending inventory to my good product are going to be left at the $450,000. So again, given the ending inventory there, given the fact that they have sold maybe close to 80% of that amount, that would be the ending inventory, the cost of goods sold. And generally speaking, the production method will give you a little bit higher gross margin. So while it is a little bit more of a little bit more problematic in terms of debits and credits, the upside is you get a bit higher gross margin. And then this, I won't recognize anything. I will create an inventory account for my byproduct. When I do this, I'll essentially credit work in process for $85,000, debit an inventory account for $85,000. So every time I sell a pound of it, I will debit cash, if you will, and credit my inventory for $10. So to a certain extent, it's a little bit more involved, but I do get a little bit better control over my cash transactions. Plus, I get a little bit higher gross margin with this method than I do with the other method.